Hello everyone, you're welcome back to our channel, and today we are going to simplify something that might seem really complex. Basel 3 norms. You must have heard about this phrase quite often, but you might be wondering, isn't that something to do with banking and finance? Yes, you're absolutely right. But don't worry, we are going to break it down and make it super simple. So let's jump in. To understand Basel 3, we first need to understand why it exists. Imagine you are running a bank. Your job is to keep customers' money safe and give out loans to people who need it. But of what if too many people can't pay back their loans? Well, your bank could lose a lot of money. And in a worst case scenario, it might even go bankrupt. This can cause a lot of problems, not just for your bank, but also for the economy as a whole. That's what happened during the 2008 financial crisis. Many banks had risky loans and not enough reserves to cover the losses. And when the loan went back, the bank had to declare bankruptcy. And this led to chain reaction, causing a global economic meltdown. Well, to prevent this kind of crisis from happening, a group of banking supervisors from around the world came together in a city called Basel in Switzerland, and they established a set of rules known as Basel III. Now think of Basel III as a health check for banks. It sets minimum standards to ensure the banks are healthy and stable. The first pillar is all about the amount of capital a bank must have. This is the bank's own money, not the depositors. This buffer helps absorb losses from risky loans. The second pillar focuses on risk management. It wants banks to assess their own risk and have a plan in place in case things go wrong. And the third pillar encourages transparency. Banks are required to disclose information about their operations and risk, which allows investors and customers to make better decisions. So the first pillar is certain standards of capital. The second pillar is risk management. And the third pillar is transparency. So in simple terms, Basel III is all about ensuring banks have a safety net, managing risk effectively and being transparent to the public. And the result, more stable banks, safer economies, and hopefully fewer financial crises in the future. That's Basel III in a nutshell. Remember, while this might seem like a distant concept, it directly impacts our economy and the security of our money in the banks. If you like this video and you want to learn more about such topics, please hit the like button and subscribe to our channel. Until next time, stay curious and keep learning.